In the early 1980s, Ray Dalio, the founder of Bridgewater Associates, was on the brink of financial disaster. He was about to lose everything. But Ray didn't give up. Instead, he learned from his mistakes and understood something crucial. Inflation isn't just about rising prices. It's about how those rising prices can slowly erode your wealth if you're not careful. Today, he's one of the wealthiest hedge fund managers in the world. This is a story of resilience, but also a story of understanding how inflation and compounding work together to protect your gains. This is how to protect your gains, by ensuring that your savings and investments grow faster than inflation can eat away at them. While inflation may nibble away at the value of your money, compounding ensures that your investments have the potential to outpace inflation and grow your wealth exponentially over time. So what does this mean for you? It means that even in tough economic times, even when inflation is high and it feels like your savings are shrinking, there's a way to not just survive, but thrive. Ray Dalio didn't just hold on to his wealth, he grew it by understanding these principles. In this video, we're going to explain the relation of inflation and compounding, how these two forces can either work against you or for you, depending on the choices you make. We'll explore practical strategies to protect your savings, grow your investments, and ensure that inflation doesn't eat away at your hard-earned money. This is how to protect your gains and secure your financial future, even in the face of rising costs and economic uncertainty. So subscribe to the channel and let's get started. All right, the first thing you should do is understand how compounding interest works, especially when inflation is in the picture. This is how to protect your gains, by calculating the real impact of inflation on your compounded returns. So let's break it down. In compound interest, the interest you earn doesn't just sit there. It gets added back to the principal, meaning your money starts earning interest on the interest. For example, if your bank offers you quarterly compounding, the interest you earn in the first quarter gets added to your principal before calculating the interest for the next quarter. It's a powerful way to grow your wealth over time. But here's where it gets interesting. The effective yield, which is the actual return you get, is often higher than the quoted rate of interest. This is why banks and financial institutions like to quote the effective yield. It gives you a clearer picture of how your investment will grow. For instance, if you invest $100 at a compound interest rate of 6% per annum, and the interest is compounded quarterly, your investment would grow to $135 after 5 years. He was about to lose everything. But Ray didn't give up. Instead, he learned from his mistakes and understood something crucial. But here's the catch. This growth doesn't represent real growth because inflation eats away at the value of your money over time. Inflation and compounding. How do they really interact? Let's say the inflation rate is 6%. To find out the real growth of your investment, you subtract the inflation rate from the effective yield. So in this case, with an effective yield of 6.76%, the real growth of your investment would be just 0.76%. This is how to protect your gains, by always factoring in inflation when you're calculating your returns. Now, it might seem discouraging to see such a small real growth rate, but this is exactly why understanding inflation and compounding is crucial. If you don't account for inflation, you might think you're doing better than you actually are. But by being aware, you can make smarter investment decisions and ensure that your money is working as hard as possible for you. So as we move forward, keep in mind that the goal isn't just to earn interest, but to make sure that interest outpaces inflation. This is how to protect your gains and make sure that your wealth is truly growing over time. In the next section, we'll dive deeper into strategies to make sure your investments are inflation-proof. Stick around, because what we're about to cover could make a big difference in how you manage your money in the face of rising prices. Let's keep going. All right. Now that we've talked about how compounding works and how inflation can affect your returns, let's dig a little deeper into why it's so important to consider inflation when you're investing. The example we discussed earlier, where you invested $100, was pretty straightforward. But let's face it, as a serious investor, you're probably looking to build wealth over the medium to long term, not just with small amounts, but with significant sums. So let's say you've got $1 million, maybe from a performance bonus or some other windfall, and you decide to park it in a bank FD at a 6% interest rate. After 5 years, you'd see your investment grow to $1,346,855. Sounds pretty good at first glance, right? But here's where reality kicks in. In the real world, you also have to think about taxes. The interest you earn on that FD isn't tax-free. If you fall into the 20% tax bracket, you're going to lose $69,371 to income tax. That leaves you with a post-tax return of about 5.55%, which brings your total amount to $1,277,484. This is how to protect your gains, by understanding that what looks like a good return on paper might be less impressive once taxes and inflation are factored in. Now, let's factor in inflation, which, in this case, we're assuming is 6%. If your post-tax return is 5.55%, but inflation is at 6%, your real return is actually around negative 0.45%. That means your money's buying power is actually decreasing over time. Inflation and compounding. How they interact is crucial, because even if your money is growing in nominal terms, it might not be growing in real terms. This is why it's so important to ensure that your investments are not just earning interest, but are growing faster than inflation. The goal is to make sure your hard-earned money doesn't lose value over time. This is how to protect your gains, by choosing investments that can outpace inflation, giving your wealth the real growth it needs. So as you plan your investments, always keep inflation in mind. It's not just about how much money you'll have in the future, but what that money will actually be worth. In the next part of this video, we'll explore some strategies to help your investments grow faster than inflation, so you can truly protect your gains and build lasting wealth. This section is about how compounding plays a crucial role in making smarter financial decisions, especially when it comes to large purchases. This is how to protect your gains. By understanding the power of compounding and how it can work in your favor, even when making big financial choices. For instance, let's suppose you're planning to buy a car worth $20,000. You have two options in front of you. The first option is to take out a car loan. Your bank offers you a loan at 7.5% per annum under the reducing balance method with a repayment tenure of 5 years. It seems like a straightforward choice, but let's break down what it really costs you. Over those 5 years, you'll end up paying a total of $2,022 in interest. So, by the time you've paid off the loan, the car will have cost you $22,022 in total. This is how inflation and compounding affect your financial decisions. Every dollar spent on interest is a dollar that's not compounding and growing your wealth. Now let's consider the second option, saving up for the purchase instead of borrowing. What if, instead of taking out that loan, you decide to save $400 each month and invest it at a modest 6% per annum in a recurring deposit or another investment vehicle? After 5 years, your savings would grow to around $24,000, thanks to the magic of compounding. Not only would you have enough to buy the car outright, but you'd also have an extra $4,000 in your pocket. This is how to protect your gains, by allowing your savings to grow through compounding rather than losing money to interest payments. By choosing to save and invest rather than borrow, you're letting the power of compounding work for you. Instead of paying interest to a bank, you're earning interest on your savings, which helps your money grow over time. Inflation and compounding, how they interact, can significantly influence your financial decisions. When you opt to save and invest, you're not just avoiding debt, you're actually building wealth in a way that keeps pace with or even outpaces inflation. So when you're faced with a big purchase, think carefully about the long-term impact. Borrowing might seem like the easier option in the short term, but saving and allowing your money to compound can put you in a much stronger financial position in the long run. This is how to protect your gains and ensure that your financial decisions are working for you, not against you. By the way, if you're enjoying the video so far and want more topics like this, comment the word "more" so I know. All right, now that we've explored how saving and compounding can put you in a stronger financial position compared to borrowing, let's talk about the best long-term investments for beating inflation and growing your wealth. This is how to protect your gains by choosing investment avenues that not only keep pace with inflation, but actually help you build wealth over time. When it comes to long-term investments in the U.S., options like mutual funds, ETFs, and hybrid insurance products stand out as effective tools for growing your wealth while protecting against inflation. These investments harness the power of compounding to generate returns that can outpace inflation, helping you secure your financial future. Mutual funds and ETFs allow you to pool your money with other investors to buy a diversified portfolio of stocks, bonds, or other assets. For instance, if you invest in a mutual fund with a compounded annual growth rate, CAGR of 7%, your investment could double in about 10 years. This is how to protect your gains, by letting your investment grow at a rate that exceeds inflation, so your money gains real value over time. Mutual funds and ETFs are particularly effective for beating inflation in the long run because they typically invest in a mix of assets, including equities, which tend to offer higher returns compared to other investments. Many of these funds also come with tax advantages, such as the ability to defer taxes on capital gains until you sell your shares. With the flexibility to invest regularly and the potential for systematic withdrawals, mutual funds and ETFs are powerful tools for growing your wealth. And remember, there's no maximum limit to how much you can invest, giving you the freedom to compound your wealth to your heart's content. This is how to protect your gains and ensure your investments are working hard for you. Now let's talk about hybrid insurance products like Variable Universal Life, VUL, and Indexed Universal Life, IUL insurance. These policies combine the elements of life insurance with investment options, allowing you to build cash value over time. When you invest in a VUL or IUL, your premium payments are split between the cost of insurance and an investment component that compounds over time. These policies are particularly flexible because they allow you to invest your cash value in a range of options, such as mutual funds or index-linked accounts, giving you a balanced approach to risk and return. However, it's important to note that these products can come with higher fees and complexity compared to traditional investments, so they may not be suitable for everyone. VUL and IUL policies also offer added benefits for long-term investors, including the potential for tax-free withdrawals and the ability to adjust your investment strategy as your financial goals evolve. This is how to protect your gains, by choosing a plan that not only grows your money but also offers you flexibility and tax benefits along the way. Both mutual funds, ETFs, and hybrid insurance products like VL and IUL are excellent options for building wealth. But once you've built that wealth, the next step is to preserve it. Large assets like real estate or diversified savings plans can be great for this purpose. The key is to make sure your investments yield inflation-beating post-tax returns, ensuring that your hard-earned money doesn't lose value over time. Inflation and compounding, how they work together can significantly impact your financial future, so choosing the right investment avenues is critical. Saving is essential, but investing in the right asset classes and financial instruments is what really sets you on the path to financial security. This is how to protect your gains, by making smart investment choices that not only preserve your wealth but also allow it to grow, even in the face of inflation. So, as you plan your financial future, consider how these investment options can help you achieve your goals. To sum up the whole discussion, understanding inflation and compounding is key to protecting your gains and growing your wealth over time. Remember, the goal is not just to earn returns, but to ensure those returns outpace inflation so that your wealth grows in real terms. By being mindful of how inflation impacts your investments and by leveraging the right tools and strategies, you can build and preserve your wealth for the long term. Now, it's important to note that the purpose of this video is to educate you on various aspects of investing, not to give you specific investment advice. Investing involves risks and uncertainties, and you should always do your own research and consult with qualified professionals before making any financial decisions. Keep in mind that past performance does not guarantee future results, and it's crucial to consider the risks before putting your money at stake. If you found this video helpful, I highly recommend watching my next video, which perfectly complements what we've discussed here. Don't hesitate to share this video. It might help someone else make smarter financial decisions. Subscribe to the channel and share your thoughts on today's video in the comments. Thanks for watching, and I'll see you in my next video.